Welcome to Tasty Trade's Options Strategies series. In this episode, we will discuss buying a put option, which is a bearish option strategy. To start, we'll break down the basics of a long put. Next, we will cover some scenarios where put options can profit and realize losses. And to wrap it up, we will discuss some risks investors should consider when trading long puts. Now, let's get into the basics. What is a long put, and why would an investor choose this strategy? A put option is a contract that gives the owner the right, but not an obligation, to sell or short an underlying at a fixed price, known as the strike price, on or before the option's specified expiration date. Options that can be exercised and converted to shares prior to expiration are known as American-style options. Traders may purchase a put option to speculate on the downside movement of the instrument they're trading, since it allows them to hold the theoretical equivalent of 100 shares of short stock for the duration of their put contract expiration. For example, let's say an investor buys a $100 strike put on XYZ for a price of $3 that expires in 40 days. This gives the investor the right to sell or short 100 shares of XYZ at $100 per share over the next 40 days in exchange for paying $300. In our example, we are paying $300 because standard options quote in units of 100, which represents the number of shares each contract controls. So you must multiply the quoted price by 100 to determine the cost of the contract. Since each option contract controls 100 shares, if there's a substantial decrease in the underlying price, there's potential to quickly yield profits with long puts. And by only paying a fractional amount of the value of 100 shares of XYZ, purchasing long puts can provide investors with a less capital-intensive way of gaining bearish or downward exposure to a stock. However, purchasing puts is an inherently risky option strategy, since you can rapidly lose a part or all of your investment quickly. Now let's cover what makes up the value of a put option. The price of a put option, or any option for that matter, is made up of extrinsic and intrinsic value if it has any. When a put option strike price is greater than the current market price of the underlying, it has intrinsic value because it offers the owner the right to sell or short 100 shares above the current market price. If any option has intrinsic value, it is said to be in the money. In-the-money options before expiration can and usually do have extrinsic value as well. Many factors can affect an option's extrinsic value, but two common factors are days until expiration and the implied volatility of the underlying. An option's extrinsic value directly correlates with how many days it has until expiration, also known as time value. Factors like heightened volatility can add to an option's extrinsic value too. Let's take a look at another example. An investor buys an XYZ $100 strike put for $6 that expires in 30 days. If XYZ is trading at $95, that means that the long put has $5 of intrinsic value per share, which is the difference between the option strike price and the current price of XYZ. The option also has $1 of extrinsic value per share, reflecting the put's time value and other factors. Like all options, it is important to note that over time, the extrinsic value of in-the-money options will decay to $0 as it approaches expiration. In our example, if the price of XYZ stayed at $95 through the option's expiration date, the option's extrinsic value would decay and likely trade near $5 or its intrinsic value. When a put option has a strike price below the current stock price, it is said to be out of the money. When an option is out of the money, it only has extrinsic value. Investors that buy out-of-the-money put options can potentially yield a profit at expiration if the underlying decreases in price below the option strike price, since it allows investors to sell the underlying value above the current market price. Out-of-the-money puts that remain out of the money or in-the-money puts that become out of the money can decrease in value over time. At expiration, if the underlying price is greater than your put's strike price, the option is worthless because the ability to sell an underlying below the current market price has no value. In essence, long put holders want the underlying price to rapidly decrease below their strike price on or before expiration to make a profit on the trade. However, buying options can be an uphill battle since they suffer from time decay, and a put option's value may decrease each day if there are no swift downward movements in the underlying price. Now that we've gone over some of the basics, let's dive deeper into some profit and loss scenarios at expiration. If we take a look at the profit and loss graph, long puts can reach max profit if the underlying drops to zero. Let's say, for example, XYZ is currently trading at $100. An investor purchases a 95 strike put on XYZ stock for a price of $2 that will expire in 45 days. The break-even point at expiration for this position is $93, as the investor would need the put to gain $2 of intrinsic value to offset the put's upfront cost, not including any commissions and fees. After 45 days, if XYZ decreased to $90 at expiration, the put would be in the money and the long put would automatically be exercised at expiration. Assuming the investor had sufficient account equity to take on the short shares, the put would convert to 100 short shares of XYZ at $95 per share. Come the next trading session, if XYZ remains at $90, the investor can buy back 100 shares of XYZ at $90 to secure $500 from the closing trade. However, the $200 you paid for the put would offset that for a net gain of $300, excluding commissions and fees. Conversely, if XYZ remained at $100 and above the put strike price at expiration, the put option would not auto-exercise since it expired out of the money and worthless, resulting in a max loss of $200, excluding commissions and fees. While buying a put option can be a less capital-intensive way to get bearish exposure to a stock, there are some risks and other factors to consider. When you buy an option, there is always the risk that the option expires out of the money and you lose the entirety of your investment. There is also the risk that your long put is exercised at expiration, resulting in the sale of 100 shares of the underlying, even if you don't have enough cash in your account to cover the margin requirements. There is always an option to submit a do not exercise or DNE request to avoid your in-the-money puts getting automatically exercised. DNE requests only apply to long options, and investors will forfeit the option's value by submitting one. Generally, option traders who do not want the underlying asset seek to close, or in this case, sell their puts before expiration. Once an option is closed, it can no longer be exercised or assigned. If your put is exercised into short shares, be aware that investors shorting or borrowing shares may be charged a hard-to-borrow fee each day those short shares are held. Also, if the investor is short a stock that pays a dividend, then they may also owe the dividend too, also known as dividend risk. Lastly, factors like theta or time decay negatively impact the value of an option and are not beneficial for long option holders. Theta decay becomes exponential as an option approaches expiration. Hence, the longer you hold a long option, the more susceptible it is to time decay. Also, contractions in implied volatility, or how quickly an underlying price fluctuates, can decrease an option's value. Successful long put trading requires a correct directional assumption and quick price movements to compensate for lost time value to potentially yield a profit. In any case, purchasing puts can be a capital efficient way to get bearish or downward exposure to an underlying while capping your max loss potential. Looking to open a long put on the desktop platform? Check out our tutorial videos here. Learn more about trading strategies and concepts on tastytrade.com/learn.